The stock on our radar is SJS Enterprises. The company operates in value-added aesthetics space. The company delivered double-digit revenue growth and strong cash flow generation in the fourth quarter, looking to outperform the industry going ahead as well. Sanjay Thapar, who's the group CEO and executive director, joins in now. Thanks a lot, Mr. Thapar, for joining in. You know, the obvious question, over the last couple of years, you've seen a big jump in your revenue. 433 crores in FY23 turned into 760 crores in FY25. What's your prognosis in terms of revenue growth for FY26 and beyond? And the margins as well. While, you know, your revenue has grown, your margins have stayed between the 24 to 26% band. Where does that number go to?
So what we've been guiding the market is that we've outperformed the underlying industry each quarter for the past 22 quarters that we've been listed. So we will continue to outperform the industry this year as well. Our guidance really is that we'll be 2x of the industry rate of growth for the financial year 26. In terms of margins, we've been fairly steady. So last year we recorded 26.4% EBITDA margins, and we expanded margins, in fact, by 1.29%. So we continue to see very strong traction with our customers across markets, including India and exports, and we are quite bullish.
All right. Hi, Mr. Thapar. Good morning and welcome to the show. This is Nigel on this side. You know, I'm looking at a brokerage report coming in from Elara, and they are quite bullish on your company. They are talking about, you know, from the last year that you've done around 760 crores. They believe by FY28, your revenues will be in the vicinity of around 1,250 crores. Do you think it's possible?
Yes, it is. So we see we continue winning very large businesses, both in India and overseas.
Okay.
And we have, as I said earlier, very bullish. We've set for ourselves a set of products that are unique, and that gives us a lot of traction for growth.
So 1,250 crores of revenues with mid-20s margins, correct?
Yes, we've been fairly consistent at the margin delivery for a company.
Okay. All right. Let's focus on your kit value then. If I look at your kit value, you know, currently majority of your business comes in from two-wheelers, but you'll have gradually been focusing on PVs as well. And out there, the kit value itself is 3 to 5 times what you have in two-wheelers. Could you tell us how do you see your revenue mix shape up? You know, a note states that from around 17% of total revenue contribution from PVs, they're expecting it to go to more than 35%. Do you concur? And how can you improve on the kit value in each of your segment, the consumer durables, two-wheelers, as well as PVs? Please go ahead, sir.
Just a fact check. So we are already, last year we finished with 40% revenues from the... So we very successfully pivoted the company. Traditionally, it used to be a two-wheeler focused company, but no longer. So two-wheelers are just about 34-35% of our sales.
Okay.
Passenger vehicles are 40%. As you know, passenger vehicles, there's a large product mix that we are in a position to supply to, both for the interiors of the car and the exteriors. So basically, there are many much great opportunities lying ahead of us.
All right. Yeah, Mr. Thapar, apologies for that. Actually, I was referring to the way you'll have moved from 2021 to 2025. So that's why the error in that calculation, 17 to around 35-40%. Got that. The kit value, sir, that's something that you'll have improved on as well. If I look at the same duration, 2021, two-wheelers were between 300 to 500. Now it's 600 to 1,000. PVs were around 1,500. Now it's at around 3,500. So for each of these segments, how do you see the kit value increase?
So what we have done is we've added some very high value added products, especially with the acquisition of a company called Walterpack from Walterpack, Spain. That brings in our portfolio a very large set of products, that is IML products for the interior of the car. A car could use roughly from 1,000 rupees to a 5,000 rupee IML component in a car. So traditionally, we used to supply just about 80 rupees in FY19, that increased to about 350 rupees in 21. Then we acquired a chrome plating company, Exotech Plus, now called SJS Decoplast, which added about another 1,500 rupees to the kit value. With Walterpack, we added another 4,500 to the kit value. And now we are looking at entering in this area of optical glass, which is the center track display that you have, which will again very significantly add to the kit value. So what we are looking at really is potentially a 10,000 rupee kit value for a passenger vehicle. And there are large markets for this, both in India and the overseas markets.
By when does this 10,000 rupee come?
I mean, we don't supply all the products to all the models. These typically go on the high-end cars. But as we've seen, the trend towards premiumization is that more and more of these high-end products find their way to the mid-segment and ultimately to the entry-level vehicles as well. So
Got it.
driving the theme of premiumization. So it would, I guess, take time, but it's anybody's guess as to when this will come. But directionally, we are on the right path.
Right. You know, that's very interesting because I remember the last time you joined us, you did indicate that you are likely to see a higher share of revenue coming in from these premium products, Chrome included, and new gen products, which earlier were sub 15% of your sales, have now moved to closer to 30% of sales as well. I wanted your thoughts on client additions and market share, because on the one hand, you can increase your revenue by increasing the kit value and the offerings that you make. The second hand, your revenue increases by the number of models that you supply to or the number of companies that you tie up with as well. On that front, what is the kind of guidance that you can give us? What are the new models that you're looking at for both two-wheelers and four-wheelers? How long do these contracts last, and what will the value of each of these contracts be going forward?
The four-wheeler contracts are long duration, so they're roughly about 7 to 8 years lifetime. For the two-wheeler products, there's a model change that happens after 1.5 years. So coming back to the customer addition, so we've done some very notable customer acquisitions in the recent past 6 months. So we've added Hero MotoCorp as a customer, a mainline customer that opens up doors of great revenue growth in the domestic market. On the export markets, we've acquired a global business from Stellantis across geographies. So we will supply to India, Europe, North America, Latin America. And this is for the first time that we will have complete ownership of the branding of the vehicle. When I say branding, it means that the nameplates that go on the vehicle, all of them will come from SJS. So I think great progress. And what's heartening to note is that we did not win this because of lower cost, but of new technology that we introduced. So I think that's the reason to be, I think, for the team to be proud of.
Yes.
We hope to replicate this with other OEMs globally.
Well, kudos, sir. Kudos, in terms of that explanation as well that you've given us. Now, we have a number that's on the screen, and you were saying that Stellantis, and I think among other, international customers as well, you have, I think, Whirlpool among others. Could you give us a couple of details? I think currently your export contribution is around 7.5%. But the street believes that in the next 3 years, it can go to around 13 to 15%. Do you think that is possible? And also, if you could tell us, the order size, the RFQ of export orders, how does it differ from the domestic order?
So, I mean, the route is the same. You need to give tech shows. You need to give proposals of how you can add aesthetic appeal to vehicles, and the OEMs evaluate you. Pretty much what happens in India. The recent order that we won from Stellantis is a 300 crore lifetime revenue business to be delivered over the next 7 to 8 years. So that's a good starting point for our export journey. And as I said, this is just tip of the iceberg. So we have good reputation with global OEMs, and we hope to continue this foreign exports even more aggressively. And yes, by FY28, 13 to 15% of our top line should come from exports. That is our endeavor.
All right. So 13 to 15% comes in from exports by FY28. Out of curiosity, who are your competitors in this space? Because it is a niche business, and I'm sure that a lot more other players would be eyeing something like this as well. What is your moat and market share against them?
Okay, so if I talk of the domestic market, I think we are very strongly placed. Overall, I would say that there is no competitor that I know of, either in India or globally, which has all the technologies that we have under one roof. So we are largely, it's a fragmented market. So there's a chrome plating player, he just does chrome plating. Whereas when a customer comes to us for a decoration part, chrome plating is on his mind, but we can offer him a menu card of options at different price points. And that is the key differentiator between us and competition. So as I said, there's not a single company in India or even overseas that I know of, which has about 14 different technologies that we offer to the customer. So we are quite unique in that space. And the differentiation lines from the trust that we've been able to build in customers, both domestically and export-wise. Our supply chains are very robust, both on the supply side and the purchasing from our suppliers.
Right.
Okay.
That
And
is the
what other large companies do you not supply to which can become potential game changers for you? You said you recently signed a deal with Hero MotoCorp. I'm sure, you know, in the four-wheeler space and in the two-wheeler space, there are some other large players as well who you don't supply to. Are there any other big client wins that we can expect?
in India, virtually we have everybody who's in the top 7, 8 companies in that industry. We already are supplying to them, but that doesn't mean that we supply to all their models. So we are, of course, hungry for more business, and there'll be more models that will come our way. We present a compelling value proposition to the customer. That our focus is.
All right. Final question, Mr. Thapar, before we let you go. You're sitting on cash of around 100 crores. Is that correct?
That's right.
And I think your capex for the year is around 160 crores, which you will fund via internal accruals, right?
That's right. We generate close to about 80% of EBITDA gets converted to cash flow from operations. So
Got it. So that brings me to my question then with regard to inorganic growth. You've done it in the past. Are you on the prowl yet again? I believe that some inorganic plans are being stated out, and that could get closed in this fiscal. Would that be correct?
maybe next year. So we keep gunpowder dry. We are not in a hurry to complete an acquisition, but at the right valuation. And primarily the acquisition would be to improve market access. So that's...
So it will be in the overseas market. Is that correct?
Sorry?
Will it be in the overseas market?
In the overseas market, but it's not that we have shut our eyes to the domestic market. If there are good opportunities at good values, which can add value to our company, why not? But
and what space will this be and what size of acquisition are you looking at?
We are looking at bite-sized acquisitions. We don't believe in taking huge amount of debts. We are a debt-free company, and we continue to do that. So maybe a top line in the region of about 400, 500 crores is what the size of the acquisition is at the moment. But again, depends on the price that we get it at.
That will be a large bite.
Not such a large.
Your annual revenue is 760 crores. So you're looking at a company which does 450 odd crores. So that is obviously, you increasing your revenue by nearly 50-60% immediately. Even if you look at 1 year forward, it's an increase of nearly 35-40% immediately.
And you are trading, sir, on a sales basis. You're doing 750 crores of sales and your market cap is already around 4,000 crores. So if you're looking at a 400 crore, a company that has 400 crores of sales, will it be on a similar valuation basis or will you be willing to pay less, maybe twice sales or 3 times sales or 1 time sales?
No, so the industry that we operate in operates on the margins that this company generates. So as you are aware, we are a high margin company. We would look at, we are looking at companies where we could add value to improve margins. We've done that successfully with the acquisitions we've done in the past. So our rule book is very clear as to what is the side of company that we are looking at and what is the profile of the company. So we don't want to do a turnaround business. We will see where synergies can play. We can expand margins in that acquired company.
Okay. All right. Got it, sir. Maybe for the next discussion, we'll probe you a little bit more in terms of this inorganic growth. But thanks a lot for joining in and detailing the roadmap for the next 3 years or so.
All right. That's about SJS Enterprises. But while